Well, thank you all so much for taking the time to join me today. Welcome back to Principles of Accounting 1. Appreciate you all joining today. I know that we are in the midst of a very busy middle of the semester. A lot of you are taking other courses, the midterm exams are coming up soon. So I know that you're all working very diligently. I sincerely appreciate your hard work in this course. I want you to know that. It means a lot to me. Okay? You probably don't hear that all the time, but I want you to know that I appreciate you and I appreciate the hard work that you're doing in this course. And hopefully that means a lot to you as well. And it should, because your hard work is showing, right? You're making progress. That's a great thing. I want to remind you of a couple of things about this course. Number one is making sure you take care of those LinkedIn learning certificates and adding those to your LinkedIn profile. They add value to you. Okay. Uh, those LinkedIn learning certificates, uh, yeah, they're really important. They're heavily weighted in terms of the grade, and they add value. So make sure that you've completed and submitted those. And again, if you need help with that, just let me know. Number two, that I wanted to say is in regard to the quizzes. If you're not happy with a quiz grade, if you're like, man, I really wish I could have done better, I want you to know that you could take it a second time. All the quizzes in the course you can take up to 2 times. Okay, and the higher of the two grades will be taken in the grade book. So just be aware of that if you're not already, and I'm sure that you are. But I just want to remind you of that. And the third thing I want to make sure that you're aware of is we are quickly approaching the midterm exam. We're in week 6 now, so we're almost halfway through with the course. Next week we'll cover accounting information systems, and then the following week here in week 8, we'll talk about internal controls, very short chapter, but we also have the midterm exam on March 3rd. Okay, so just be aware that it's there, it's coming up, and week 8 is going to be a busy week. So feel free to work ahead if you want to. Everything in this course is open, so if you want to, forge ahead and make awesome progress, you can do that. There's absolutely nothing wrong with working ahead. In fact, I oftentimes encourage it. Everything's open, right? Even the midterm exam, you could open it up and look at it. Absolutely. Yeah. There's no timers on anything. Yeah. But I just wanted you to be aware of these things because I know that sometimes it can be a little overwhelming. There's a lot to do in this course. So just be conscious and aware of these things. Yep. So here we are today in week 6. We're about to talk about inventory and the cost of calculating that inventory. It's actually just before spring break, Maria. Great question. Just before. It's that Sunday before spring break starts. Great question. So this week, we're going to talk about inventory. And to supplement that conversation, there is a hypothesis annotation. And we've done these before. Be very aware of the requirement. It says make 2 annotations and respond to 2 of your classmates. Yeah? So in other words, you should have 4 total posts within the hypothesis. If you have questions about that, or you don't understand that for whatever reason, please let me know. Because I don't want you to misunderstand something, right? How to do the hypothesis, of course, is right here, just above it. So that's your work for the week. in addition to the quiz. So, having said those things, let's go ahead and jump in on our conversation about one of my favorite topics: inventory. Inventory, as you know, is one of those things where a business sells products. Those products that the business sells, we call that inventory. Inventory. That's its technical name. Some businesses call it merchandise. Merchandise, inventory. It's the same thing. Same thing. Okay. Inventory, by selling it, it's how the business generates sales. Real straightforward, right? And we've talked about inventory a little bit before, haven't we? We talked about it when we covered current assets. You remember what current assets are? Those are the things that the business owns, and they typically utilize those current assets within a year or less. Current assets includes things like cash, accounts receivable, inventory. Yeah, those are what we call current assets. Prepaid insurance, current assets. Inventory is really important to understand because most businesses have inventory. Yeah. If you work in retail, that is the primary business. It's inventory. If you work in manufacturing, guess what? Inventory. Yeah. If you work in other areas, inventory probably impacts your business somehow. So that's why it's really important that we understand it, we understand how to calculate it, uh, and we understand how to utilize inventory. So uh, last week when we talked briefly, very briefly, about credit terms. Remember, credit terms is when we sell something to a customer and we give them terms. We say, "Hey, listen, if you pay me back in the first 10 days, I'll give you a percentage discount, like 2%. Otherwise, all things due in 30 days. We call it 210 net 30, right? We talked about that last week. The reason why I'm bringing that up again is because in that same conversation, we also talked about who's responsible for that inventory while it's in transit. Remember? We had free on board and free on board destination, right? Or shipping point, sorry. So in that conversation, it aligns with inventory, our conversation on it. Okay. Free on board shipping point, free on board destination. Yep. Merchandise inventory includes all of the goods that the company owns and holds available for sale. Remember, inventory is a current asset. The company owns it until they sell it. We hold it available for sale. I had mentioned one of my favorite retailers is Macy's. Remember? I like Macy's. Real cool company. They hold inventory in their stores available for sale to their customers. Yeah, that's all the stuff that they sell. Merchandise is accounted for regardless of where it is, as long as the company owns it. You see? So, a big company like Macy's, they got a lot of stores, they got warehouses, they got uh, you name it, right? The company owns all that stuff. So we need to account for all of it, regardless of where it is in the process. We're going to talk about a couple of things related to this that require some special attention. One of those is called goods in transit. That's the free onboard shipping point. That's, of course, where uh, the goods are included in the buyer's inventory when it's shipped. And free onboard destination. That's, of course, where the goods are included in the buyer's inventory after arrival at destination. It's related to what we talked about last week. Remember the credit terms: free onboard destination, free onboard shipping point. It's who's responsible for the inventory while it's in transit. That's what it tells us. So, goods in transit. We're going to talk about that here in a second in a little bit more detail. The second item you see here is called goods on consignment. Can has anyone on the call today in the classroom, have any of you ever been to a consignment shop? And do you know what a consignment shop is? Consignment shop, anyone? I've been to several of them. Have you ever been to a consignment shop? No?
Is it essentially like a secondhand shop?
Actually, yes. Yes, that's exactly what it is. It's not like Goodwill. I'm not gonna. So Goodwill would not fit in this category, but a secondhand shop would. A consignment shop, as Ashley alluded to, it's also known as a secondhand shop. And the way it works is you go into this consignment shop, and they have inventory on what we call consignment. Here's what that means. Let's say I have all these antiques. I love antiques. I got a bunch of antiques. I have some antiques that I want to sell, but I don't know how to sell them. You know what I mean? It's like, I'm not going to sell a desk on eBay. It's just not going to happen. So, what am I going to do with this antique desk? I'm going to bring it down to a consignment shop, and I'm going to list my desk at the consignment shop for sale. Then someone will buy it from the consignment shop, and the consignment shop will give me the money from the sale. The consignment shop works as a middle person. You see, it's a like almost like a meeting place where the sellers of their goods bring the goods to the consignment shop, and people buy those goods from the consignment shop. They have like these little tags on all the items, right? And there's a little number written down, and it helps to identify who it belongs to, right? And so the consignment shop records the sale, and then they give the sale revenue to the seller, to the original owner. You see, that's what a consignment shop is. Goods on consignment is just that. Someone else owns the inventory. They bring it to the store to be sold. It's what we call on consignment. It's a we won't go too deep into it, but I just wanted to help you understand what it is when we do talk about it. And the last thing that's relatively special is called goods that are damaged or obsolete. And we talked about this. Remember our convenience store? We had our convenience store, remember? And we talked about that last week. And remember, there were moments where we had to send some stuff back to our vendor, like, hey, this is broken, or this isn't any good. It's stale, or whatever the case is. So we have to return it, through or we do returns on allowance returns and allowances, right? So that happens sometimes with damaged goods. We either send it back or we do an allowance and sell it on a discount. And then you see this one that says obsolete. Does anyone know what does it mean to be obsolete? What's an obsolete product? Who can tell me? What is an obsolete product? What does it mean to be obsolete? Hopefully, I'm pronouncing that right. I think I am.
Does it mean like lesser than?
Actually, yeah, you're on the right track of mind with that. On the right track. Uh,
No
doesn't
longer
fit the
being
time frame
used.
anymore, D'Angelo. Yes, I mean that's also right. Who else was just speaking? I'm sorry,
That was me. I
is
said
it
no, no value.
Sam? No value. Yeah, yeah. Uh, technically, yes. So, I don't know what I don't even know what number we're on anymore. iPhone 15 is that the latest one? I don't even know. I don't have an iPhone, so who can tell me what's the latest number? What are we at now? Is it 15? What's the?
15.
It is 15.
Yeah.
Okay, great. Thank you, Maria. So iPhone 15, right? Latest and greatest iPhone. What does that mean for the iPhone 14? It's obsolete. Okay, it means it no longer holds that same relevance, that same value that a new one does. See, technology, when it comes to technological things like televisions, phones, um, even cars, really. But technical things go obsolete very quickly. Why? Because they're replaced with the next best thing. When something gets replaced because it doesn't fit the time frame anymore, like D'Angelo said, that means it's obsolete. You see, that's what the term obsolete means, and there's a way to account for that as well, because as Sam said, the value, as Ashley said, the value gets reduced. So we're going to talk about those. Good conversation. Okay, so goods in transit, free on board shipping point means that the buyer is responsible for that inventory while it's in transit. And free on board destination means that the seller is ultimately responsible for the goods while it's in transit. Okay? So there's a nice little graphic representation of this concept down here. The seller ships the goods are in transit, it reaches the buyer at the destination. See, while it's in transit, the seller's responsible for that inventory while it's until it reaches its destination. That's what the graphic represents. So again, it's all about who's responsible for the inventory while it's in transit. Goods on consignment. As I mentioned, the consignment shop concept. The consignment shop is the middle person. The consignor is the person who's selling the goods and they own it. Okay? They ultimately sell the goods, but who's actually doing the selling? The consignee. This is the consignment shop. You see? The consignor is the person who owns the goods. They're giving it to the consignment shop to be sold. The consignee is the person selling it on behalf of the consignor. You see? Merchandise is included in inventory of the consignor. Remember, inventory belongs to the owner of the business. So they technically own the inventory. Marlon, please.
So would the consignee be a service industry or service company?
A consignment shop could be considered service. Yeah, I mean, technically they're providing a service. Um, the consignee is really a consignment shop. It's think of it like an empty store where people who own inventory come to sell it. You see, um, so I guess you could consider the consignee a service. Yes, that's technically what it is. Yeah,
Okay,
that's
so if you were the accountant for a consignment shop, you would use the accounting methods involved in the service industry.
that's correct. That's absolutely correct. Yes. Yeah, that's a great. Yeah, that's exactly right.
Thank you.
Yeah, good question. Very good question. Consignee never reports consigned goods in inventory. Simply put, the consignor, that's the person who owns the inventory, they're giving it to the consignee to sell for them on their behalf. You see? Yeah, that's consignment. Great questions. Damaged goods. There's a couple ways to report damaged goods. Damaged or obsolete goods are not reported in inventory if I cannot sell them. It's not inventory if you can't sell it. You see what I'm saying? Inventory are goods that the business owns available for sale. If the goods are damaged or obsolete and I cannot sell them, then they are not inventory. I take them out of inventory if that's the case. You see? This one is very common in retail. I'm going to give you a couple examples. I'm going to give you my real life experience with this particular point here. A long time ago, very long time ago, I used to work for this company called Sears. Okay, some of you may remember them. Hasn't been that long since they've been gone. Sears was a major retailer in the United States, very similar to what Macy's is today. They actually came about uh, just before Macy's did. It was one of the oldest retailers in America. And so, uh, what they used to do, and I witnessed them doing this, and to this day it still bothers me. So, if let's say the company, I'll just tell you what happened. So there's a bunch of TVs that the company didn't sell. Okay, they're just sitting in inventory. Uh, they weren't selling, and so ultimately they became obsolete because, like I said, with electronics, if you don't sell it quickly, it becomes obsolete within 6 months. You know, very, very typical because the next model's there to replace the previous model, right? So I saw this happen with a couple of TVs. And so what we did is, well, I didn't do it, but what we did is we took them out of inventory because they're obsolete. We can't sell them. And then the company destroyed them. They brought these brand new unopened TVs to a trash compactor in the back and threw them in and destroyed them because they were obsolete. That still bothers me because it's not, first of all, it's not environmentally sustainable. Second of all, they could have just donated them. Uh, but this happens all the time in retail. It drives me crazy personally. You know who also does this is H&M. H&M is a clothing retailer, just in case you don't know who they are. Um, Relatively large company. Their clothes are very inexpensive. Uh, we call them fast fashion. Okay, fast fashion. The reason why they're called fast fashion is because they're constantly producing new clothing over and over and over again. You know? So what H&M does with their obsolete clothing is they burn them. Yeah, they destroy new unused clothing when it becomes obsolete rather than donating it. Sam asks, oh, you okay? Yeah, yeah, it's unbelievable. I just every time I see it, it bothers me, and and I always ask management. I always ask management. I says, why do you do that? And just donate it. You know, Tim, do you want to annotate something? Is that what you're asking here? Not too sure what's going on there. But yeah, it's very very interesting. Clothes will be set aside in a box. They should be. They should be set aside in a box, but they're not. Um, yeah, it's just wild stuff. Anyway, I'm sorry I digress so much. That's something that still bothers me today. Damaged or obsolete goods that can be sold are included in inventory at what we call their net realizable value. Net realizable value is the sales price minus the cost of making the sale. Okay. Net realizable value is the sales price minus the cost of making the sale, selling cost. Basically, the value that way is decreased rather than being zero. Yep. Loss is recorded when the damage or obsolete occurs. So, to Sam's point, as you've seen in the chat here, what the company does is they write it off. They take it out of inventory when it becomes damaged or obsolete. They record it as a loss. So whatever the cost was of obtaining that inventory, they record that cost at a loss. Uh, and that's just unfortunately a part of doing business. Okay, so let's talk about the cost of inventory. Inventory is not just the purchase price of the inventory. It goes beyond it. It goes beyond the cost of acquisitioning the inventory. I had mentioned the story about Macy's. Macy's purchases their inventory through distributors, as I had mentioned, and those distributors purchase the inventory from the manufacturers. You see, so when Macy's purchases the inventory from the distributor, that's the purchase price. But it's not the inventory cost, you see, because we need to add in a couple of things, like the cost of shipping it, the cost of storing it, insuring, and any import taxes. All of those costs are included in the total cost of inventory. You see, because it's the total cost of acquiring that inventory. That's inventory cost. So it's the inventory cost minus any discounts and plus all of those other costs I had mentioned. It is so important that if you're dealing with inventory, you need to take a physical count. Okay? Please make sure you do it at least once a year. At least once a year. Most businesses do it twice a year. Some do it once a year. It depends on the size of the company. Yeah. For example, back in my days at Sears, we would do inventory twice a year. Huge store, very large store, but very big footprint. Like Macy's, it's big. It's a big store. We did physical inventory twice a year. Okay. It was a little bit more expensive to do it that way, but it was important to do it that way. There's a couple of reasons why we do physical counts of inventory. Number one is you got to make sure you have all your inventory. Okay. And it has to match what you have in your accounting system, your QuickBooks or your, whatever you're using. And number two, if there is a loss of inventory, you need to record it, whether it's through shrinkage, meaning somebody stole it, or it got lost, it got destroyed, it got damaged, whatever. You have to record that loss. Yeah. So that's why we do physical counts. The way that we control it is through inventory tickets. That's why, like, sometimes if you go to the store and you're like, what the hell are all these little tags everywhere? They're doing inventory. That's what that is. We call them inventory tickets. The counters have no inventory responsibility. They just scan it and they enter in how many units are on that shelf, but they don't have responsibility over it. They confirm the existence, amount, and condition of the inventory. A second count is often taken by a different counter. And the reason why that happens is because the first person who counted the inventory got to make sure that their numbers are right. Right? It's kind of like doing an audit on that. And the fifth thing is that managers confirm all of the items that have been counted only once. Okay, and that's usually like special items. It's a part of what we call internal controls. Every business needs to have a set of solid internal controls. We're going to talk about internal controls in about 2 weeks, I think. Might be next week. I think it's the week after, though. Okay, now that was all the background information on inventory. Now we're going to get to the fun stuff. How to assign cost or value to your inventory. There are 4 methods that are commonly used. There's more than this, but these are the most commonly used ones. The first method is called specific identification. Specific identification is a method that we use for unique products in inventory that we do not sell frequently. Okay, here's what I mean by that. A vehicle has what we call a vehicle identification number, also known as a VIN. It's unique to that vehicle. Only that vehicle has that number. Okay, every vehicle has a unique vehicle identification number. It's usually in the door jamb. It's also etched in glass on the windshield and a couple of other places on the vehicle. Okay, it's a way to identify that vehicle. That is called specific identification. And so dealerships commonly use specific identification when they sell their inventory. Okay. Other examples of companies that use specific identification might include, let me try to think, maybe a boat dealership. They probably would use it because boats or any type of water vessel has what we call a boat haul ID. Haul ID. And then other larger unique things like a watch, for example. Expensive like a Rolex or whatever. It has a specific identification number. It has a serial number. That's specific identification. And that's how we assign cost to those types of inventory. It's specific, so it's very easy to understand. The second one is called first in, first out. Think about the physical flow of inventory. When the inventory is purchased from the distributor and they back the truck up to the loading dock and they're bringing it into the store, it's coming in first. You see, coming into the store first. And for perishable products, like at the grocery store, we want to sell that first. Why? Because if it sits on the shelf, it's going to go bad. Okay, so grocery stores commonly use the first in, first out method to assigning costs because their products are perishable. This is also true probably with electronic stores, first in, first out. And the reason for that is because they don't want the products to become obsolete. Yeah. So yeah, that's first in, first out. We'll talk a little bit more in detail about that. The third one is called last in, first out. The last inventory that we purchased from our vendor is the first one we're going to sell. We stacked it on top, okay, of our existing inventory. Last in, first out. Companies that would do last in, first out would be clothing retailers, shoe retailers, footwear retailers. Those types of businesses would use last in, first out. And then we have what we call weighted average. Just as the name implies, the weighted average is we take all of our purchases that we've made throughout the month or the year, well, probably throughout the month, and we average them out. So if I made 3 purchases and they all have different costs associated with them, I take the total of those costs and divide by 3. That's the average. Yeah, you see? So I'm going to show you what each of these looks like, except for specific identification, because again, specific. Okay, so here we have first in, first out, last in, first out, and weighted average using the same series of purchases. Now, I'm going to show you how it works. It's relatively straightforward and easy to follow, but as some of you might discover when you take the quiz, it's not always that easy to trace. Okay, so I'm going to walk you through it. First, let's do this one called first in, first out. In, first out, I'm going to sell the first purchase first. You see? First in, first out. Our company, we made 3 purchases so far in the month of May. All right? The first purchase was for $45, the second one was for $65, and the third purchase was for $70. Using the first in, first out method, I'm going to sell the first purchase I made first. First in, first out. You see? So that means that $45 purchase I made, I'm going to sell that inventory first. Okay, so I sold that first purchase for $100. It cost me $45. So therefore I have a gross profit of $55, right? Sales minus cost of goods sold equals gross profit, as you know. So my cost of goods sold in, first out is going to be $45. Why? Because it's the first purchase that we made and we're selling it first. First in, first out. And here we can see my gross profit's $55. My inventory balance is $135. How did we get that? Remember, it's the balance. It's whatever's left. I sold the first one, so that means my remaining 2 purchases is still in inventory. 65 plus 70 is 135. Okay, makes sense? On to last in, first out. As the name implies, I'm going to sell my most recent purchase, my last purchase, first. I'm going to sell it first. Okay, last in, first out. The last purchase I made was $70. Most recent purchase was $70. So I'm going to sell that first. Remember, I'm selling my inventory for $100 a piece. I bought this particular one at 70. So my cost of goods sold is 70. That leaves me with a gross profit of $30. Sales minus cost of goods sold equals gross profit, $30. My remaining inventory balance is 110. How? 110? 45 plus 65 is 110. That's last in, first out. And then the third one you need to understand is called weighted average. Just as the name implies, we're going to find the average. I made 3 purchases, 45, 65, and 70. I add those 3 purchases together to get 180. I divide by 3 to get the average, which in this case is $60 each. I'm selling one of those units. The cost is $60. It's the average. Sales, 100 minus 60 for cost of goods sold equals $40 gross profit. My remaining inventory balance is 120. How 120? Remember the average. $60 each times 2 is 120. Okay, so those are the 3 ones that we're going to be looking at. Now you're wondering, you might be asking yourself, or you might be asking me, Dr. B, I see that the purchase prices are all different. Why is that? Well, that's the market. You know what I'm saying? You pay something for something today, it's probably not going to be the same price tomorrow. You know what I mean? Because inflation, because demand, market demand, yeah, that's what dictates the cost of things. And so every time you go to purchase your inventory, there's a good chance you're not going to be paying the same price, for every purchase. That's just the normal course of business. When we look at things like specific identification, first in, first out, last in, first out, and weighted average, it's really important to follow the physical flow of the inventory. That's what tells us how much merchandise we have available for sale. We purchased it, it gets sold. We purchased it, it gets sold. Right? It's the physical flow. Beginning inventory plus your purchases equals the merchandise that you have available for sale. Another way of finding merchandise available for sale is we take our ending inventory plus our cost of goods sold. Yeah. Okay. I'm going to talk to you a little bit more about the inventory systems. And I think, and if I'm not mistaken, we talked briefly about the perpetual inventory system before. Remember, there's 2 types of inventory systems that are commonly used. One is the perpetual inventory system, and the other is called the periodic inventory system. With a perpetual inventory system, it's where it's continuously updating. It's perpetual motion, continuous, yeah? So every time that barcodes get scanned, it takes the inventory out of inventory and puts it into cost of goods sold. It's perpetual, automatically updating, continuous, yeah? So I'm going to show you how to compute specific identification, first in, first out, last in, first out, and weighted average using this perpetual inventory system. It's the most commonly used. Yep. As you know, hopefully you know this, the balance sheet shows us our balances. Ironic, right? Our asset balances, liability balances, and equity balances. Okay. Under assets, we have current assets and long-term assets, also known as fixed assets. And under our current assets on the balance sheet, we have an account called inventory. Okay. Inventory affects the inventory balance on the balance sheet. It also affects cost of goods sold on the income statement. Why? Because as I sell my inventory, inventory comes off the balance sheet and goes onto the income statement as cost of goods sold based off of the value of the inventory that I sold. You see? So let's jump into our example. Oh, sorry. Here we have some information. Our company is selling mountain bikes, okay? So here we have some data for the month of August. We started the month of August by with 10 bicycles in inventory. We started the month of August, which means we ended the month of July. We ended the month of July with 10 units. We began the month of August with 10 units. So we got 10 bicycles on the shop floor, and the cost of those bicycles to us was $91 a piece, giving us a total cost of $910 for the 10 units. On August 3rd, we decided, hey, we need to add to our inventory, so we made some purchases. We purchased 15 additional bicycles from our vendor. Our vendor charges us $106 a bike for a total cost of $1,590. It's 106 times 15, yeah. That raised our total inventory up to 25. 15 plus the original 10. August 14th, we updated our sales record. We had several customers come in on August 14th, or maybe before then, to purchase some bicycles, 20 of them. We sold those bicycles at $130 a piece. That, of course, reduced our balance. Our inventory got reduced by that 20 that we sold. Because remember, it comes off the balance sheet and onto the income statement as cost of goods sold. Our inventory went down to 5. So I got 5 bikes available for sale. What does that mean? We got to purchase more bikes because we're selling them. August 17th, my vendor came through. He brought in another 20 bicycles. This time it cost me $115 per bike. $2,300. That brought my balance up to 25. August 28th rolls around. I decided to purchase some more bikes because I got a big sale coming up. I bought 10 more. This time it cost $119. That darn inflation, right? Cost $119 this time. For a cost of $1,190. My total inventory on August 28th was 35 bicycles. 35 units. August 30th, I sold 23 bicycles at $150 a piece. Yeah, right. That's good. Very well done. That left me with, at the end of August, with 12 bicycles left on the shop floor. Okay. You see at the bottom here my totals. I ended up purchasing for the month of August 55 bicycles at a total of $5,990. I sold 43 of them. Okay. Why is that important? Because as we go through specific identification, first in, first out, last in, first out, and weighted average, you'll see the difference based off of this information. Okay? So just keep this in mind. Here we go. The first one, specific identification. Very easy to follow. Like I said, for something like this, we would say that we're selling it based off of the serial number on the bicycle. It's specific identification. Okay. So in specific identification, I don't really care about first in, first out, last in, first, any of that stuff. Doesn't matter to me. It comes in and I sell it. Okay. So my cost of goods sold, August 17th, I sold a bunch. You see? I sold 43. I bought 43 units. I sold 12. I'm sorry. I bought more than that. I sold 43 of them. I ended the month with 12. And you can see that based off of specific identification, I'm just using whatever is left. Yeah, it's a very straightforward process. Specific identification. It gets a little bit more complex with the next two, yeah? First in, first out. As I had mentioned with first in, first out, the first purchase I make is the first purchase I'm going to sell. First in, first out. The oldest cost, or the first purchases, represents cost of goods sold. Why? Because the first purchases I made are the first ones I'm going to sell. The most recent cost, most recent purchases, that's going to be in my ending inventory. Why? Because I sold the stuff I bought first. You see? So here's the same scenario, same data, using the first in, first out method. So I had my original balance, my beginning balance of 10 bikes at $91 a piece. And then I made the purchases, right? On August 3, I went up to a total inventory balance of $2,500 on August 3. Now here we are, August 14th. This is when I made the first sale, right? I sold my original balance that I started the month with, first in, first out. And I also sold 10 units out of my 15 unit purchase. You see, because I was left with 5. So I add those 20 units to get 1,970 for my cost of goods sold. That left me with 5 units at $106 a piece. That's what was left. Remember, first in, first out. August 14th, I made some more purchases, as you know. I purchased 20 more bikes at 115. I added that to my balance. My balance went up to 2,830. And I said, oh, I need 10 more bikes. I added that to my balance, and now we're up to 4,020. Then August 30th, a bunch of sales came in, right? I sold a whole lot. So I sold the first in remaining balance, 5 bikes at 106. Sold that first in, first out. And then I sold 18 bicycles out of the purchase I made from August 17th. Because remember, on that day I sold was it something, however many bikes, I forget. For a total cost of goods sold of 2,600. That left me my balance, inventory balance of 1,420. 5 bikes remaining out of that August 17th purchase, and then 7 bikes. I'm sorry. Yeah, it's what was left on the August 17th balance purchase. So, my cost of goods sold total was 4,570 using first in, first out. Now let's do last in, first out. As I mentioned, the last purchases I had made are the first ones I'm going to sell. Last in, first out. This means that the most recent costs of inventory, most recent purchases, are going to be on my cost of goods sold. And the oldest purchases, oldest costs, are going to be on my ending inventory. Here's where it gets a little tricky for you, possibly. And because remember, it's a continuous process, it's perpetual inventory. And I'm buying and selling throughout the month, every month. So that means that my cost of goods sold is going to keep updating perpetually, you see? So because we're talking about last in, first out, I'm going to sell the last in first, you see? So we made our purchases. We had our beginning balance, as you know. Then we made purchases on August 3rd. Now here are August 14th. We're selling. Now you'll notice that I'm selling the most recent purchase, last in, first. So those 15 bikes I bought on August 3rd, I'm selling those first. You see, 15 at 106, 1590. And then I'm selling 5 bikes out of my original beginning balance, $91 a piece, 455. You see that my cost of goods sold is $2,045. That's a lot different than what we just saw with first in, first out, right? This means I have a remaining inventory balance of $5. I'm sorry, 5 bikes at $91 a piece, 455. That's also very different from first in, first out. And then August 17 to August 28, I made those purchases, as you know. And then on August 30, I sold a bunch more bikes. According to the last in, first out rule, whatever my last purchases were, the first ones that I'm going to sell. So I sold 10 bikes at 119 from my August 28th purchase. I sold that first, 1,090. And then I sold 13 bikes from my August 17th purchase at 115 a piece, or 1,495. If you add those two together, 2,685. Substantially different from first in, first out. And then take a look at what's happening on my inventory balance. I still got those 5 bikes from the beginning balance back on August 1. And I had 7 bikes from my remaining from my August 17th purchase. You see how that works? So that's last in, first out. Taking a look at the cost of goods sold amount, $4,730. Substantially different from first in, first out. Okay, so we covered those two. Now let's cover the weighted average. As I had mentioned, the weighted average is the average of the purchases, average cost of the purchases. Now, you're probably thinking to yourself, well, you've made a lot of purchases throughout the month. So how does that work? Right? Because you're selling. We have to do it um, based off of the purchases before we sell. And here's what that looks like. So August 1, I had my beginning balance. August 3rd, I made those purchases, as you know. The so how it works, and just as we looked at this, the cost of goods available for sale at each sale is divided by the number of units on hand at the date of each sale. So here we have my beginning balance plus my purchases. Okay, I averaged those out. You see, $100 per unit. How did we get $100 per unit? Our total inventory divided by the number of bikes that we have available. In this case, 25 on August 3rd, $100 per unit. I assigned that $100 per unit to the cost of each bike on August 14th when I made the sale. So I sold 20 of them at $100 per unit. Total cost of goods sold, $2,000. Okay, and that $100 per unit follows through. Okay, but then, as you know, I made more purchases after that. August 17th, made more purchases. Purchased 20 more bikes. I bring that in, and then I rebalance the cost per bike. I take the total cost, divide that by the number of bikes I have available. In this case, 2,800 divided by the 25 bikes gives me 112 per bike. Right? It's perpetual inventory. And then August 28th, made another purchase, as you know, brought in that total, added it to the existing balance. So that what that does is I take my now 35 bicycles, so 3,990 divided by the 35 bikes gives me an average cost per bike of 114. See, perpetual. And then, as you recall, on August 30th, I made a sale. At that time, the assigned cost, the average was 114 a bike. Yeah. In other words, we're continuously updating. Yeah, continuously updating. It's perpetual. Okay. So you'll notice that my total cost of goods sold under the weighted average is 4,622 with an inventory balance of 1,368. Now, hopefully, eventually, I'm going to show you what these three look like side by side, or the fourth look like side by side. And the way we're going to do this is to show you the side by side comparison. Now, you might be asking, Dr. B, what's the reason? Why do businesses do this? Why do they select one over the other? Or, what's the advantage here? Taxes. Taxes is the advantage. Okay. Businesses, as you know, have to pay taxes from our sales, right? We got to pay taxes on our sales. We made sales, we got to pay taxes. We have inventory, we have to pay taxes on those too, on our inventory. Why? Because the business owns inventory. And that inventory has a value. Businesses get taxed on their inventory. So that's why we do one of these three or one of these four. So with first in, first out, the ending inventory approximates its current cost. Last in, first out, cost of goods sold in the income statement approximates its current cost. And with a weighted average, it's what we call smoothing of prices. Yeah, those are the reasons and the differences between the three methods. And then, of course, specific identification is related to the exact cost. Yeah. So, given our example that we just walked through with the bicycles, look at this side-by-side comparison. Okay, we see specific identification cost of goods sold 45.82, first in, first out 45.70, last in, first out 47.30, weighted average 46.22. And you see what it does to the gross profit, right? So why does all this matter? A couple reasons. The business gets taxed on its profit. Yeah. So the higher the profit, the higher the taxes the business is going to pay. So if I decide, instead of using first in, first out, I'm going to use last in, first out because it'll reduce my overall tax liability. That's the real reason. That's the real reason. And then, of course, the inventory. Yeah. And what it does, the inventory balances. So that's the reason why businesses will select one of these four over another, is because they want to reduce their tax liability ultimately. And that's what this tells us. IRS requires that last and first out be used for tax reporting, but it'll also be used for financial reporting. We call this conformity. Last in, first out, in most cases, is actually the best for most businesses to use because it reduces the overall tax liability of the company because it reduces their total profit. Another concept you need to know about as we're talking about inventory is what we call the lower of cost or market value. The lower of the cost or market value. This is a concept that I want to talk to you about. The lower of the cost or market value requires that inventory must be reported at its market value. The market value is the cost of replacing inventory when the market value is lower than its original cost. Call that market value. An example of this, a vehicle, a car, we'll say, a used car, okay? You purchase a brand new car, it gets old, right? Because you're using it. And miles on, wear and tear, blah, blah, blah. What happens to the value of the car? It goes down. You're using the asset, which is the car. It goes down in value. Right? We know that. We know that. When we remember when we talked about depreciation. Yeah. So the value of the asset goes down. Same concept applies with inventory over time, right? So inventory must be reported at its market value when the market value is lower than its cost. Call this rule the lower cost or market value. We can apply this in three different ways. One is separate to each individual item. Two is a major categories of that inventory. And the third method is to the entire inventory. And it really depends on what it is that you're selling, honestly. And when we do this, this is how it's applied. So here we have examples of two vehicles. two types of vehicles, sorry. We have the Roadsters and the Sprinters. Okay, we got 20 vehicles of the Roadster available. Our cost was $8,500. The current market value is $7,000, giving us a total cost of $170,000. The market value cost is $140,000. We apply whichever is lower. It's the lower cost or market. In this case, the market value is lower, so we apply $140,000 in total cost to the Roadster. For the Sprinter, we got 10 vehicles of it. It cost $5,000. The market value is $6,000. Our total cost is $50,000. The market value is $60,000. We used the lower one. In this case, the cost is lower. So we apply $50,000. You'll notice that our lower cost of market applied to these two items equals $190,000, which is less than the original $220,000. That means I have a $30,000 reduction in the overall value of my inventory. In order to make this adjustment, we do what we call an adjusting journal entry, where we debit the cost of goods sold of $30,000 to increase the cost and reduce the inventory value by $30,000. Okay. Lower cost of market. Very, very common, especially when it comes to vehicles. And of course, the impact on the income statement and the balance sheet. With those types of adjustments, when it comes to making adjustments for lower cost of market or for inventory, let's say we have some inventory shrinkage or we have some obsolete or damage, we need to adjust. Anytime that our ending inventory is understated, meaning that we're saying we have less than we actually have. It's understated. That meant that our cost of goods sold was overstated. Net income was understated. So we make the adjustment. When we make that adjustment, cost of goods sold becomes understated and net income becomes overstated, right? Because of the adjustment. If, in the event that our ending inventory is overstated, that means our cost of goods sold was understated and our net income was overstated. So, of course, we need to make an adjusting entry to fix this, right? Just like what we did last week. Cost of goods sold needs to be overstated and net income needs to be understated. See? And this just summarizes the impacts to help us to understand what happened on the income statement. We made the adjusting entries. When we make the adjusting entries, it fixes what's going on in our inventory, total inventory, which is, of course, on our balance sheet under assets. Inventory is an asset account. And when we make those adjusting entries, because we're also impacting cost of goods sold, that means we're affecting ultimately our equity accounts. Okay. A couple of ratios you need to be aware of. One of those really important ratios that you want to know about is called inventory turnover. And the other one is called days sales in inventory. Inventory turnover, also called merchandise inventory turnover, is a ratio that we use to tell us how many times the company turns over its inventory in an accounting period. How quickly am I selling it? Okay. I'm turning it over. How quickly I'm selling. To calculate this, we take cost of goods sold divided by average inventory. When you see the word average in accounting, it means average. So we take the beginning balance plus the ending balance divided by 2 to get the average for inventory. Beginning balance of the inventory plus the ending balance of the inventory divided by 2 to get the average inventory. Days sales and inventory ratio tells us how many number of days in sales does it take us to go through our inventory if we don't purchase any new inventory? It's kind of like saying, how much inventory we got left? How long is it going to last us? That's what it tells us. We take ending inventory divided by cost of goods sold and multiply by 365 days. In other words, how long do I have it before it goes out of stock? This is a good one. If you're in retail, this is a good one to know. Tells you how long it's going to last before it goes out of stock. It gives you warning time to make new purchases. Here's an example of both of these inventories applied to Costco and Walmart. Yeah, it's interesting. Very interesting stuff. Now, you know that the perpetual inventory system is the best. It's easiest to use. We use the barcode scanner. What about the periodic inventory system? Well, as you know, with the periodic inventory system, that's where we're doing physical counts. Okay, we update it periodically, not all the time. We follow the same process overall. Yeah, the balance sheet, ending inventory, income statement, cost of goods sold. All that's the same. But the primary difference is when we're using the periodic inventory system is we're periodically, once in a while, updating it. Right? Not all the time. That's why you don't see all that data over here under unit inventory. We'll keep adding the purchases, right? Periodic. This shows us cost of goods sold under the periodic inventory system. Again, it's just periodically updating. You know, and you notice it just follows a very straightforward flow. Yeah, there's no carrying this and carrying that. Again, periodic. Yep. Just follows that physical flow. So first in, first out. Very straightforward. It's periodic. Notice that the periodic inventory system under first in, first out follows exactly the purchases, as they're being sold. Because remember, periodically update them. Under last in, first out, the same concept applies. Of course, we're still selling the last purchases first, but you'll notice that we don't update it as frequently because it's periodic. And of course, when it comes to the weighted average cost system, we assign the average cost just as we would with the perpetual inventory system. However, of course, we don't update everything regularly because it's periodic. Yeah, that's why we don't see a whole lot of data here. Retail inventory. Sometimes you can estimate it. you could estimate the value. And the reason why you might estimate inventory value is because for insurance, you need to estimate how much value you have in all of your inventory. If something happens, like a flood or fire or whatever, you can't do a physical count. So you have to have an estimate of the value of the inventory. And we do that in 3 different steps. First step is we find the cost available for sale at retail price minus all sales equals ending inventory at retail. Step 2 is we find the cost to retail ratio by taking the cost available for sale at cost divided by goods available for sale at retail. And the third step is we take the ending inventory at retail found in the first step times the cost to ratio retail that we've got from the second step to find the estimated ending inventory cost. It sounds pretty complex. I'm not going to really test you on that, but just want to let you know what it was and why we did it. And we could also, of course, estimate the overall inventory cost using the gross profit method. And that we take the sales times 1 minus the gross profit ratio to find the estimated cost of goods sold. Then we take goods available for sale minus cost of goods sold equals ending estimated inventory cost. Again, not going to test you on it. I just want to let you know that we can estimate, and we typically do this for insurance purposes. Okay, are there questions, comments, concerns that you have about inventory, about how to value the inventory, anything like that at all? No, are you all good? Marlon, go ahead, Marlon.
Professor, do you create the quiz or does Blackboard create the quiz?
I create the quiz. I
Ah,
create all the quizzes. I should say that the quizzes come from your book. Okay, I select the questions on those quizzes from the book. I'm not writing all those questions. I'm not writing all that.
You said our midterm is the week before spring break.
Yeah. So, awesome question. So yes, the midterm exam is going to be in week 8. The midterm exam is going to be on March 3rd. Okay, that's the Sunday before spring break. Spring break is from the 4th until the 10th. That's the spring break period. That's why you don't see it here in the classroom. Great question.
And it'll cover all the chapters from 1 to 8.
That's correct. Yep, it'll cover chapters 1 through 8. It's open and available now, so if you want to take a glance at it and you're curious about what kind of questions are on there, yeah, do that. Someone might ask, Dr. B, are we going to do a review for the midterm exam? Yeah, absolutely, we are. Yeah, definitely. I'm gonna help guide you through the exam. We'll talk about where to in the chapters to find um, the information to help you to answer those questions.
Thank you.
Yeah, you're very welcome. 100%. Okay, great. So just as a reminder, what's due this week? Today's Tuesday, so on Thursday, I would really like you to complete your hypothesis for this week. As you can see here in the instructions, you need to make 2 original annotations and respond to 2 of your classmates. If you're confused about how to make the annotations, it's right above there under Engage and Explore. We have the video annotations, and this there's a short video just kind of shows you how to do it. But remember, you need to have a total of 4, 2 original ones, and then 2 responses to 2 different classmates. So I'd like you to do that in class time on Thursday, and then by Sunday night or maybe even on Thursday if you feel so ambitious, to complete the Chapter 6 quiz related to what we just talked about today. So those are your marching orders. If you have late work, please make sure you do that too. Okay? Don't skip anything in this class. I promise you, if you skip stuff, you won't pass. You have to do the work in this class to pass it. Okay? So if you still owe things like, I don't know, a LinkedIn learning certificate, please get it done. Don't skip stuff. I'll still give you credit, but I need you to do it. Yeah, and I'd like you to do it as soon as possible. Really, if you're late with it. And then, of course, if you have any comments, questions, or concerns, you can email me, call me, or set up office hours. You know I'm always here for you. Always here for you. Always. I thank you all so very much for your time today. I appreciate every single one of you. Thank you so much. Have a wonderful rest of your night. Take care. Bye bye. Good night. Good night.